Hi everyone, I'm Damien.
And hi, I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences over 20 years in the game. So you can skip through the mistakes we made and go straight to property investment success. Welcome, Jeremy.
Thanks, Damo.
How are you?
Yeah, good. How you doing?
Very good. So look, today we're going to be discussing Property Investing 101. Pretty much to understand the basics of property investing, discussing the fundamentals and covering the big question, is property investing even for everyone? Because I guess there's a lot of people out there who make you believe that it is.
Yeah, it's not for everyone.
It's not.
It's not for you.
So I guess I'll start. Why is property investing such a popular avenue for people or for investors?
Yeah, and it is popular, isn't it? Especially in Australia. Well, the thing that I like about it is that it makes sense. I'm a human being. I know what I want to live in. So as a general rule, I've got the fundamentals. I don't want to live under a flight path. Some people are okay with that, as long as the price is reasonable. By contrast, something like shares or crypto, I've got no idea. And I've got a good track record of having no idea.
Yes. And look, I was inspired to talk about this because it's great to just get the basic understanding of property investing and why. And I agree with you. I like that tangible part about property. I've had exposure to crypto, shares, and they haven't been great experiences, but you learn through your experiences. So I think that tangible part, I think past performance, seeing how, I guess, properties have done so well, and there just seems to be more and more demand out there. And look, I think it's people in Australia, we just like property, don't we?
Yeah. Well, you got to have a roof over your head. So it's not like you find with the share market that a stock goes to zero. They liquidate. That's not really going to happen in real estate. There have been some circumstances, some markets which have become ghost towns, but that is really, really infrequent. Whereas it happens comparatively quite often in the share market, even in crypto.
Yeah, I've had a financial planner in the past and pretty much picked a lot of stocks, which is fine. Like, I was very aggressive, wanted to go growth, and a couple of those companies went bust. So I think I had around a fair bit in there, and then it's just when it goes to zero, it's like, ooh, that hurts. Yeah. Where if I had my time again, I most probably would have just gone, you know what, if it dropped by 10% or 15%, maybe I sell or something. But I guess that's long-term view.
And it's that safety that you've got in real estate, which is A, makes it more popular, and B, why banks are so willing to lend against collateral of real estate, because it just doesn't go to zero.
I think the other bit where you say, like, I think stability and that rental income is really important, why people find property, like you get into property investing because of that aspect.
Yeah. And then there's diversification from shares. So you start off with shares maybe, and then you get to a point where maybe you can afford an investment property. It's just a different asset class. So a lot of people have been pretty good with the shares, and then they've just decided, I'll sell up this parcel and buy real estate to diversify my financial future.
It also could be that you might just be holding cash or savings and don't know what to do. And a lot of people might not even realise, well, your superannuation, like with current legislation, you can access it at 60 if you retire. You can always talk to a financial planner about that, but that's invested in the share market. So when you check your statement, that's what it's actually invested in. So you do have exposure, and it is your money eventually. So, having that property in your portfolio can just diversify when you transition in.
Yeah.
And you don't need 5, 10, 4, 5, like you don't need a ton of properties. Like you hear all the time, 10 properties, 20 properties, 30 properties. It's just not realistic, in my opinion.
Yeah. Not for the average Australian. I mean, if you're on a high income, you could probably buy quite a few more. Yeah. And then, of course, it depends on, the price. Another thing that I really like about property is your control of it. So you compare, for example, owning some shares. What control have you got on those, apart from I can choose to sell them? And you can vote at the annual general meeting, and your vote's insignificant, really. And even if you knew like what to vote for or how to, would you know how to manage one of these big companies that you've got shares in? I wouldn't know. But when you've got that property, you've got the ability to renovate and add value, maybe increase the rental income as well. Yeah. You could subdivide the property. You could knock down the house and build duplex or townhouses. So you've got some ability to manipulate the rental income or the value of that property, which you don't have if you've got a portfolio of shares.
Yeah, with the shares, so I always get those letters in the mail and they go straight to the bin normally with stock options, and I'll just go, and I tell them I want to go paperless, but I still keep getting them in the mail, which is interesting. But I think the other thing is also the financing with property, that leverage aspect that you can get from property. So, let's say you buy a $500,000 property, you need to come up, we'll just say about 120 because we have to factor purchase costs and stamp duty, but it's just that leverage, you're borrowing a lot more. So let's say you borrow $400,000 for a $500,000 property. You don't have to try and save towards that property. You can leverage from it.
Yeah, so you've put in, say, $120,000. That's your investment. Now, if that property grows by 20%, which can happen in a single year, that's for a $500,000 property. That's $100,000. So you've got almost a 100% return on your investment within a single year. So that's outstanding. The capital growth in property is the ants' pants.
And I think with working with clients in the past, I just want to reduce my tax. I want to save on tax. Like I've heard that so many times. And I'm like, look, you want that asset that's a good quality on a big block of land that you can add value to it. So you just get that growth over time instead of just saving a little bit of money on tax, because people don't realize you might be saving on tax. Let's say negative gearing, like it's $10,000 that you're potentially in the negative. You can only claim, let's say, 30% of that or 40%. So you're not really getting all the money back. You're still losing money.
Yeah, it's still a loss. It's still a net loss. It's just not as big a loss. And you know what else that I rarely ever hear in the shares versus property arguments? It's a lot easier to outperform the benchmark in real estate than the benchmark in the share market. So by benchmark, I mean it might be the ASX 200 or the All Ords. In real estate, it would be, what's the national growth rate? How easy is it to outperform the benchmark? Because you hear of these fund managers beating their chest, bragging about how they have had this much growth above the benchmark, above the All Ordinaries. And they call it alpha. So the alpha is a measurement of the percentage of growth above the benchmark. Well, in real estate, it's a lot easier to outperform that benchmark because in the share market, everyone's an investor. So one investor is selling stock to another investor who's buying it. One believes it's good, the other believes it's bad. One of them's going to be right, the other's going to be wrong. So the net alpha for the market is going to be close to 0%, if not exactly 0%. Whereas in real estate, you're not really competing so much with other investors because owner-occupiers outnumber investors 2-1 in most markets. So they make decisions based on lifestyle, not purely financial decisions. So they may be offloading a really good asset at a really bad time, but a good time for investors to be buying that great asset. So it's very easy to outperform the national growth rate. Interestingly, though, some analysis that Luke Metcalf has done from microburbs.com.au, he looked at investment properties over the last, say, 30 years, and investment properties compared to owner-occupied properties have actually underperformed. So investors, the one thing they're trying to do better than owner-occupiers, and they've failed at it, they're probably pursuing yield a little too aggressively, and that might be the reason. So we only looked at capital growth, not yield. They probably outperformed on the yield side of the fence, but certainly not on the capital growth side of the fence. So that comparison, shares versus property, you can't say, shares have outperformed property for the last 30 years. It is a lot easier for a property investor to outperform that benchmark.
And you can sort of pick a point in time, can't you? Like what are you comparing to? Everyone's going to try and do whatever's in their favour. But like you look at like the long-term growth rate or like the last 10 years, it's around what, 6% per annum on average, I would say, like the Australian property market.
Even for 30 years.
So that's pretty good on like, let's just say $500,000 property, 6%, let's just say on average, 30,000 a year you're making while you sleep. I love that you're not getting taxed on until you sort of sell.
Until you sell, which you might not have to. It's nothing better than just sitting on your hands and accumulating wealth.
So I think the stability is really important that we want to mention in the market. And I guess the next thing is like, what does property investing involve for someone who might be new to it? Like why would you invest in property? Why did you invest in property?
Yeah, well, because it makes sense to me, and I was dissatisfied with the performance in shares, but that's probably more a reflection of my lack of knowledge. I just found it easier to come up to speed with the knowledge required to make a decent investment property. And even then, I still made plenty of mistakes, loads of mistakes. But you learn from those as long as you've got time on your side, because property is a big investment. It can take some time for capital growth to come your way and cover over those mistakes.
Yeah, I think definitely starting out, you might hear these stories or read these magazines or Instagram posts or whatever it might be, and it can be just, I don't know, you can get down about it a little bit because you're just starting out. You might not have much in the bank, and it's like, oh, I keep missing out. But I think if you just try and put a little bit away and work towards that goal, I think you can put yourself in a good position, and it's never too late. And I think for me, the primary goal is obviously growth, yield, like both really important. But a lot of clients that I've worked with, they accumulate, they hold, and it helps them into that sort of retirement phase. And on the other side of things, I've had clients where they want to retire ASAP. So they might need to sell down. So everyone's got their own different strategy, and it really comes down to what's important for you. But that's really the reason you get into property investing, isn't it? For that financial future, stability.
Right. In a nutshell, you want to retire and have that rental income replace your salary so that you don't have to work.
And you don't want to retire. You don't want to worry about your job. You lose your job and you're freaking out. Like you want to know, okay, great, I've got a property that's there for me. Worst case scenario, I can sell it down and buy myself maybe some years, or it just gives you that sense of...
Yeah, it's funny you say that, the safety that you've got by having these rental properties. I've had lenders tell me that I'm too rent reliant. That's the term they used, rent reliant. And I'm thinking, no, hang on a sec, you're too salary reliant. I can stop working and I've got rent flowing in. You've got to keep working. It's really peculiar. But anyway, policies.
I'm not a mortgage broker, but I've got a mortgage broker that I work with, and I know the banks sort of assess like 80% of that rental income for lending and those sort of things. But there are sort of lenders that are easing up on that 90%. But why not just take all the rent? Like vacancy rates are so low. Yeah, it's just interesting. But what are some, I guess, key terms and concepts for beginners? Just purely starting out, got no idea.
Yeah, there's a lot of jargon there, isn't there? You want to take us away with what's capital growth?
Yeah, so capital growth. So it's like the property value, I guess, increases over time. So let's say you use that $500,000 example. Let's say in 3 years' time, it's worth $700,000. So that capital growth has been $200,000 in that period. So it's just that property growing over time is capital growth. On the flip side, you buy that property for $500,000. 3 years, it's worth $500,000. Capital growth is zero.
Zilch. Yeah. At least you don't have to pay capital gains tax if you were to sell it.
Ah, yes.
All right, let me explain what rental yield is, because everyone talks about yield. A lot of investors, cash flow crazy investors, are interested in yield. So yield is the percentage of rental income. It's the rental income as a percentage of the property's value. So if over the course of a year you got $25,000 of rental income and the property was worth $500,000, $25,000 as a percentage of $500,000 is roughly 5%. So if you were getting $500 a week in rent for 50 weeks, that's $25,000. So that's your rental yield.
Yeah. And I guess that ties into the next one, which is, I guess, positive cash flow. So you hear that a lot, positive cash flow, don't want anything to come out of my own pocket. So that's, I guess, more income than, I guess, expenses that are going out. So let's just use that example, $25,000 of rent coming in, and let's say $20,000 is going out. So it could be like the property manager, maybe some maintenance, council rates. The big one's most probably the interest expense. But let's say 25,000 minus 20,000, there's 5,000 left over in the year. You have to pay tax on that. It's not the worst thing because there's still money coming in. But that's just like positive cash flow. That's what you call it.
That's a good position to be in, positive cash flow. It's ideal, but it's not that common, is it?
You want the growth, ideally. Like you don't want the negative. Let's say if you've got that negative cash flow, it's the flip side. You want to be able to afford that. But as long as that property's increasing and it's got those good fundamentals, that's really important.
Yeah. All right, let me do leverage.
Yes.
Everyone talks about leverage. And this is one of the great things about property investing, the leverage. So we were talking about this earlier. You put down, say, a $100,000 deposit to buy a $500,000 property. That's a 20% deposit. So your investment is $100,000 plus, of course, stamp duty, legal fees, the other costs to get involved. So it might be closer to $120,000. So if that property grows by $120,000 over the next, let's say, couple of years, then you have got a 100% return on your investment. Your investment was only the deposit. So although you've bought a $500,000 property, your investment was $120,000. And that's why you're getting into property, to leverage. You borrow 80% of the value of the property from the bank. And that leverage just levers more out of your investment, so you get more for it.
Yeah, I think from experience and like you got to do your own research and really be comfortable with taking on debt, because a lot of people freak out about having debt. Like it's just ingrained in us. But you have to remember, if you've got your buffers in place and it's a good quality property and it's rented out, like it shouldn't really cost you much early on as you're accumulating your portfolio. So, as long as the property value doesn't crash to significantly, or you buy a high rise, or staying away from maybe a brand new high rise, or even just a high rise unit in general.
And stick away from one industry towns like those mining towns. The mine closes, game over.
Yep.
Yeah.
All right, well, I'll do the next one. So equity. So that's, I guess we mentioned before, the property value minus the mortgage. So $500,000 property minus the $400,000 the mortgage. That's $100,000 equity, and that property, let's say, grows to $700,000. Your equity now is $300,000. It's that growth you've had. So it's pretty much the property minus the debt. What's the equity? That's what equity really is.
Yeah. All right, depreciation. That one is quite confusing for a lot of people. So you buy a property, it's let's say it's a house on a block of land. The land appreciates, the building depreciates. And especially if you've bought a new property, they depreciate very quickly. So depreciation is the devaluing of that structure as it ages. As laptops age, they depreciate. Correct. So it's really just a loss in value over time. Yeah. And you can actually claim that against your taxable income. So let's say you've bought a brand new property and you're paying, you buy a brand new property and you claim $10,000 in depreciation, and a quantity surveyor can come up with these numbers for you. You claim that against your taxable income. So let's say you're earning $90,000. You claim $10,000 in depreciation. So now you're paying tax at a rate of $80,000. So there's a tax saving. Now, I don't know what the tax rates are for $90,000 or $80,000 income, but let's say your marginal tax rate is 40 cents in the dollar. So you're paying $4,000 less tax by claiming that $10,000 in depreciation. Now, that doesn't mean you're better off by $4,000. It means you're worse off by $6,000. But being worse off by $6,000 is better than being worse off by $10,000.
Yeah, and I think the red flag there needs to be is when you might be getting, might see a marketing campaign or whatever it might be saying, you're going to have depreciation. This property's not going to cost you a lot. That's when your alarm bells need to go off, because it's like, well, is it a good quality asset?
Yeah. You just need to be aware that it is a loss. It's not just the government, the ATO just handing out money. You are claiming a loss. Yeah.
The next one, I think, is the interest-only loan. So this is where you need to talk to a mortgage broker, maybe have a bit of a strategy in place, because people think, I guess, interest-only, I'm not paying down the loan. Like, they're worried about that. But the idea is that it sort of frees up cash flow for you to have as a buffer for yourself. And we'll talk more about that in later episodes about interest-only, principal and interest. But the idea is you have like an offset account, which, again, offset account is money that's linked to your loan that reduces your interest repayment. So an example would be you got a $400,000 loan. Let's say you've got $50,000 in that offset. You're only paying interest on $350,000, but you've got access to that cash whenever you need it, which is the key principle.
All right, that one's getting a bit complicated. But
Yes.
like you say, I mean, well, what's the opposite? Well, the alternative to interest only is you're paying principal and interest. So interest only means you've got a loan of say $400,000.
Yeah.
Let's say the interest rate is 5%, so you're paying $20,000 in interest a year. On top of that, you could pay off the principal. But if it's interest only, you're just paying interest. And there's pluses and minuses for that, which get a bit complicated.
Yeah, we'll touch on that later on. Yeah, hopefully don't want to overcomplicate it too much for this episode. But we'll touch on these ones. I guess real estate, like market cycles, up and downs, that's sort of normal. Conveyancing, which is sort of the legal ownership. Strata is another one.
Strata, yeah. So that's when you are buying like in a unit, a complex where there's a bunch of dwellings on the same block, on the same title. And it could be some villas as well. And there's what's called a body corporate, which is the organisation that makes decisions about where money's going to go for that block. So it might be, the lift needs an upgrade. That would be really expensive. Or it might be, we're going to spend some money on cleaning the foyer, or landscaping, if there is any lawns or whatever. Yeah. So there's some common costs that everyone pulls together to pay for, and it'll include all those sort of expenses. And it could get quite excessive for some body corporate fees.
The other one's stamp duty. So when you buy a property, you got to pay that tax pretty much.
Yeah, so that's a state tax at the time of purchasing the property. It's a one-off fee, and it's paid to the state government.
I'd say like land tax is another one. Must be quite rare unless you've got like, let's say, again, I guess it's state-based, but let's say you've got 2-3 investment properties in New South Wales. They calculate the land value, and then you get taxed on that. So you really don't need to worry about that.
Not for a beginner,
But be conscious that you're not buying in one area, or if you are, that you do factor that into your numbers.
Yeah, so again, that's a state tax. If you've bought one property in every different state, you're probably unlikely to pay land tax.
Yeah, I think the other one's just due diligence. So it's, I guess, the pre-purchase research, and then off the plan, which is you're buying a property brand new, is another term.
What is off the plan? So you're buying a property that hasn't been built yet. So you've seen some plans for it. A developer's going to build it for you, and you're deciding, I want one before it's even built, which can be a risk. But
I think I used an example I think we did in our CPA presentation recently, the one in Green Square, there next to the Green Square Library in New South Wales.
Yeah, I remember you saying.
Yeah, so they paid around, I think it was about 1.1 million off the plan around 2016. It was finished at about 2019 and resold a couple months ago for like about $50,000 less to when it was purchased. So that was off the plan, and that property's actually gone backwards.
Yeah. The ideal case is you commit to buying off the plan property for say $500,000, and before it settles, it's $600,000. That's
$700,000 or $800,000, like a lot more than what it's worth, I guess.
Another one we missed is council rates. Okay, so most homeowners would be aware of this, but if you're a renter, you might not. But you've got to pay rates to the council. So it could be a few $1,000s a year, depends on which council.
Okay. Well, is property investing right for everyone? So I guess, what financial situation do you need to be in, I guess, to start investing in property?
Yeah, it's a good question. And because we're in property investing, we obviously want to believe that it's everyone can buy an investment property. But of course, not everyone can. In fact, if everyone did, the vacancy rate would be monstrous. So I think the big issue here is cash flow. Like if you're in a position where you cannot keep owning that property and you have to offload it, timing may be really bad.
Yeah.
So it might not be for everyone, and also the massive expense to get in.
Yeah, I think that financial stability, but it's also around your lifestyle too. So like, let's say you're not saving anything every month, and you're like, I want to buy a property. That's going to put significant pressure on you. We're a different story. If you can get into that habit where you can save, every month, you go, okay, great. I want to move this money from my cash to a property.
Yeah.
So stability, I think, is really important around your income. So I guess at work, Are there redundancies happening? Is it a higher risk job of, you're losing your job? So just having that
like
stability.
Contract work, yeah.
Yeah. I think being long term, you're not going to get rich overnight. Well, you'll never preach that to anyone. It's really a long.
It does take time.
It does take time. Risk tolerance.
Yeah. So I would say that, for property, it's risk averse investors. It's very good for them because property is quite a safe haven, as they call it, safe as houses.
Yeah. I think also like research skills. Do you do it yourself? Do you use a specialist? You have to ask these questions to yourself.
Yeah. What sort of effort are you likely to put in? Yeah.
Yeah. I think we spoke about diversification. Are you interested in real estate?
You know what? I got to admit, I was never really interested in real estate. It's just a means to an end to me. I just thought this is a good vehicle for investing. But you love it, don't you?
At the start, I didn't. I didn't really know. I think I told you when I first started out, didn't know anything about it. Mum just said buy a property in Queensland because the Commonwealth Games are going to be there. And that property didn't do the best, but it's a learning experience. You learn from it. But yeah, over time, I don't know, I just love the security of it, I guess.
Yeah.
And I think just teaching people and providing good advice to help people put themselves in a better situation. What else do we have there?
Yeah, so are there certain people or circumstances where property investing might not be advisable? Like you've advised a lot of people.
I think that the big one I notice is getting your cash flows in order. So are you saving on a regular basis? Do you have that deposit? Like I've done plans for clients in the past where they only had $10,000 or $20,000, but they were committed to go, okay, I'm going to be buying in 2.5 years' time. They had a plan and every month they were hitting their goals, but they had that focus and that determination to buy that property. And they weren't swayed thinking, this isn't for me. I've only got 10,000 in the bank. They were like, you know what? I'm going to generate more income. I'm going to spend less and I'm going to work towards this goal.
What would you say would be like the minimum amount that someone needs to be able to save before they can buy a property?
It depends on the price point. Like you're buying it. I'd say maybe anywhere from start talking to a mortgage broker, maybe around that $80,000 mark, 70 to 80,000.
Right.
But it really depends on your budget and where you want to buy.
Well, there's some property markets in, say, Perth at the moment where it's a pretty hot market, be good to buy for capital growth perspective, get a decent amount of yield, and you could buy for, say, 400,000.
That's right.
So 80,000 would be ample, wouldn't it?
Definitely, for sure. And then I guess what else have we got? So maybe avoid expert opinions. So I guess is that one or not? What do you think?
Yeah. Well, there's so many people that are self-proclaimed experts, aren't they?
Well, this is the risk, isn't it? Like the risk is that you just go to someone and they sell you like an off the plan or not a great quality property. So I think you still need to do your own research, but there are a lot of good firms out there that want to help people.
I think it's pretty much the same as any industry. I was thinking about this just this morning. I used to have a mate. He was a used car salesman, deeply religious man, very honest. He would never lie to anyone. But as soon as you say used car, you think, this is a BS artist here. And I reckon that any industry is the same. You get good people, you get bad people. There are well-meaning people out there who might not know their apex from their elbow. But then you've got the minority who are just in it for themselves. They're the ones you got to watch out for.
Yeah, and the way to flush that out is I think you talk to maybe like 2 or 3 different companies, and are they all saying the same thing? Is it different? You know what I mean? Like opposing opinions. So it's just, like one might say.
It is hard to tell for a novice though, isn't it?
Yes.
Yeah, the experts, the self-proclaimed experts can sound convincing. And I've been fooled myself by a fake expert.
So I have too.
And this is when I had something like almost a dozen properties. So I wasn't exactly a complete noob. I still got fooled. Yeah. And I've found out about people, their past performance has been atrocious, and I thought they were on the level, completely legit. So, yeah, it's a difficult and dangerous space, but time cures a lot of those ills. Time covers over a multitude of ineptitude.
Yeah, and I just say always ask questions.
Loads of questions. Be skeptical.
And I think another reason why maybe property investing might not be for you is if you're not even really interested in it.
Yeah, it's a big ask, isn't it? If you're not interested.
But even early on, because you have to outlay so much cash, it's like, all right, I've outlaid, let's say 80,000. I don't have much money in the bank now. I might want to go traveling to Europe next year or you know what I mean? So you need to factor that in where other assets like cash or shares, you've got a bit more of that.
That's right. Yeah. Property's illiquid.
Illiquid. Yeah. All right. Well, let's move on from there. So I guess what preparation should someone take before diving into property investing?
Yeah, well, like you were saying about that financial stability. For me, when I was aggressively hunting out property, it was just a case of, have I got enough equity? Find the best lender I can that'll give me the most leverage. But I've learned from those mistakes.
Yeah, I think just have a bit of a plan in place, like what your goals are, what you're trying to achieve, and talk to a really good mortgage broker that can steer you in the right direction. And how does property investing fit into someone's, I guess, overall financial strategy?
Yeah, I think it's a great baseline for financial security in the future, like for retirement.
Yeah.
I just think it may not give you the biggest that rental income might not be the biggest cash flow winner, but if you've got time on your side, even if it's just as little as 10 years, so you might start at the age of, say, 55, it's so good in Australia. We really are lucky here. It's been one of the best countries to live in over the last 3-4 decades. Ever since they've been assessing internationally, assessing cities to live in, some of the Australian cities have been the best cities in the world to live in out of hundreds. So it really is a great place to live. It's been a great place to invest in property, and those sort of long-term trends are not going to evaporate overnight.
Yeah, and I think just start, buy a good quality property on a big block. It doesn't have to be, really pretty or whatever it might be. Like you can always put a coat of paint or carpet or fix up the outside, but on a big block, good. Yeah.
It's interesting because I've just recently heard of, potential client. Let's not call them a potential client. Just a friend of a friend bought sort of off the plan, newly developed property, and they're bragging about how much equity they've gained. And honestly, they're in a much better financial situation now. What they're unaware of is how it has underperformed compared to the national average. But simply being in the market, even though they've underperformed, they are better off now than if they had not bought an investment property.
Yeah.
And that's over just the last half a dozen years.
Yeah, that's the thing. If you want to utilize the leverage you can get from the banks, because let's say you sell a property, you've got all that cash, and let's say you don't buy it back in, and then the market moves, it's like, I've missed it.
Yeah, it's better to be in the market. Like, even if you've jumped on the train in the third class, that's better than chasing the train on the tracks behind it. You're in the game now.
Yeah, awesome. All right, well, I guess closing thoughts. Like, what's the key piece of advice? I think you just mentioned it then. Like, just get into the market.
You've got to get in. It's tough, but success didn't come easy for a lot of people, and buying in the right market is always going to be tough.
Yeah, and like I said before, I say it all the time, is just have a bit of a plan in place, know where you're heading, what your, I guess, personal goals are maybe first, and then think about, okay, how can property maybe fit into that? But good property, set and forget, ask a lot of questions if you are getting professional advice. So look, thanks for listening, everyone. I guess to stay updated with our property insights and content, Jez, what should everyone do?
What is it? They got to click on like and subscribe, or you just do what everyone else has told you to do, and share us with the world. Is that how it goes?
Yep. See you in our next episode. That's it. Yep. Subscribe, like, and share to the world. All right. See you in our next episode. Cheers.